All right. Hi, everyone. We are live. My name is Katie Kuntz, and I'm a social news producer here at CNBC. Today, we're going to be answering all of your questions about the latest stock market moves with CNBC's senior stocks correspondent, Bob Pisani. Nice to see you, Bob.
Hello, Katie. How are you? How's the summer?
Summer's good. It's hard to believe it's almost the end of August.
Yeah, it's parts of it have gone by very fast, and other parts have gone by very slowly. So the whole drip, drip, drip about COVID has sort of put a lot of people's plans on hold. We could talk about that, but it's been a very unusual August.
Yeah, for sure. So yeah, let's get started, and we'll start with COVID. Should investors be worried about the new COVID variants and their impacts on stocks?
Yes, I think that they should. And just look what's going on here. In a lot of ways, this is a very normal August. So in August, typically you get very low volume. We've been getting low volume. And you get sudden spikes in volatility just out of nowhere. It always happens. In the middle of August through the middle of September into October, suddenly you get days where all of a sudden you get a little selling pressure and there's not enough people interested in buying and the market just kind of droops. And the volatility, the VIX, which measures volatility, goes right up. So far, that's happened. That's a very typical August. You also get usually cyclical stocks tend to underperform. Defensive stocks like consumer staples tend to outperform. So in one sense, it's a very typical August. On the other, this is a very weird August. The Delta variant is a major problem. What's happened is the narrative has been so far that it will slow but not derail the recovery. That is happening. That is exactly what's happening. But the word slow is a problem. You can have slow as in hardly doing anything at all to significantly affecting consumer behavior. Right now, we're kind of in the middle. It's obviously starting to affect some consumer behavior, but there's a tremendous amount of confusion about what people should and should not be doing. So I'll give you an example. People down here at the stock exchange, they have a big fall schedule. They want to go to concerts. They want to go to sporting events. They have weddings to go to, receptions that are indoor, 200 people closed in for a cocktail party in an indoor environment. Is it safe for them to go? The answer is, for a lot of people, it depends on their comfort level and how many people they think are vaccinated at this thing. These are judgment calls right now and difficult to figure out. So people are a little bit confused about what they should be doing. So the Delta variant, simply put, is causing, in terms of the effect on the stock market, it's causing the markets to reprice the growth outlook. Rather than, we're all going to go out and party like crazy into the fall, it's a little more muted. There are other issues out there. China and the Fed are the big ones. China is, they're cracking down on everything over there. So this regulatory action is causing them. It's causing everyone to reprice valuations in China in general. Then you have the Fed, and the market's very sensitive to the Fed's timeline about tapering and when they're going to raise interest rates. We could talk about that separately. But if you put this all together, these risks, the Delta variant, China, the Federal Reserve, there is a risk to the market for lower valuations. The market is expensive right now. We're at historic highs. The way you evaluate, one of the metrics you use to value the market, the PE ratio, the multiple it's called, is high. It's 20, 21 times forward earnings. That's 2022 estimates. Historically, that's high. It's normally around 15 or 16 times. So the market's got a very high value. What's the multiple? A multiple is just what the market is willing to pay for $1 of future earnings. And right now, it's willing to pay a lot of money for that. But these three things, Delta variant, China, Fed, leaves the market vulnerable to a lower valuation. So you lower the multiple from 20 to, say, 18 or so, stocks are going to have to come down. Prices are going to have to come down. So the risk right now, I think, is a bit to the downside.
So let's dive into the Fed. The Fed could begin to.
By the way, that's the risk short term. Okay, I want to make that clear to everybody. Long term, I'm bullish. I've always been bullish for long. Mm-hmm. I'm talking about many years out. Yeah. I'm a long-term bull on the U.S. economy and have been. I'm very much in the traditional Warren Buffett camp that way. When I say, people ask me about what's going to happen with the markets, I have learned after 30 years of doing this that usually they mean short-term outlook, 3 to 6 months. So that's what I'm talking about.
Yeah, so one of those other short-term aspects that you were talking about was the Fed, which could begin to start tapering as soon as this year, by the end of this year. What does that mean for markets?
Right. So there's two parts of this. One is the Fed has been buying bonds, been buying treasury bonds and mortgage-backed securities for a long time. $120 billion, it's a lot of money. And that they're going to start tapering those purchases sometime. And then there's the question of rate hikes and when that's going to happen. So far, the message they've been saying is the Fed, September, they'll probably do an announcement about what the timeline is. But the street has come to believe that the tapering will start ending either at the end of this year or the beginning of next year. So instead of 120 billion, they'll taper it down by 20 billion to 100 billion or something like that until they end completely in the middle of next year, and then they'll start hiking rates sometime thereafter. That's the sort of vague timeline. I think that's probably likely. The Fed's been very good at communicating this. It's the problem we have right now is the COVID variant is thrown the market kind of off here. Nobody quite knows what's going on with this. So it could be very sensitive to sudden shocks. If the Fed miscommunicates, if all of a sudden they say, okay, we're going to start tapering earlier and more aggressively, we're going to cut it down quicker, and we're going to start raising rates earlier next year than we thought. The market is on a very thin ice right now, and that could throw it over. So there's a sudden drop. So what's a 1 or 2% nothing drop essentially could turn into a 6, 7, 8%, 10% decline. So the Fed's got to be careful because the market's delicate to communicate very carefully what they're doing. I think personally, this is just me, the Delta variant is going to cause them to be very cautious. I don't think they're going to be extremely aggressive in their timetable at all. So it's a very, very interesting moment here trying to figure things out. So far, I think the Fed's done a good job communicating their intention.
So switching topics now to earnings, can you talk a little bit about what we learned from this week's retail earnings?
Yeah, so all the retailers report, and the reason they report last is they have a different, most of them have a different quarter ending. So most companies in the United States report quarterly, and their quarterly corresponds with the calendar year. So the fourth quarter ends December 31st for most companies. Retailers are different. Their quarters are usually skewed forward, so they're skewed back. Their quarter ends, the quarter for most companies, fourth quarter for retailers, ends in January. And so their fiscal and calendar quarters aren't the same thing. And the reason that happens is because Christmas is so important for most retailers, and the weeks after that, they sort of push their final quarter forward into January. So retailers are traditionally the last ones to report, and their numbers, of course, go through to July. So generally, they've been very good. Here's the problem. The second quarter doesn't mean anything anymore because the Delta variant is throwing things off. And that's what we want to hear. And if you want a good example, Ross Stores. Now, this is a off-price retailer. They've done very, very well. And they reported today, and their second half numbers were very good. But shockingly, they actually gave third quarter guidance this quarter way below expectations, significantly, like 30%. That was quite surprising. And the clear implication here was we've had the first half of the year. That's been great. And now we have these other tailwinds, the Delta variant uncertainties. They talked about supply chain problems. And basically, the whole tone was more cautious. I think this is more typical of what we're going to see, where companies just saying, I'm not sure what's going on. Now, they're optimistic about the fourth quarter, of course, but look for companies as examples of that are emblematic of what's really going on. Ross Stores basically surprising people and saying, yeah, third quarter may not be as good as we think because of the uncertainty around Delta. That's emblematic of what we're seeing.
So we've heard a lot about regulation in China recently. I was wondering if you could talk about what does the immediate future look like for Chinese stocks?
Well, it's really cloudy. I mean, look what's happened to these big stocks in the United States. Like Alibaba is 50% off of its highs. So there's a major problem here. First, there's U.S. regulatory pressure. They've said, look, China stocks listed in the U.S., we need to have our regulators have access to the auditors so they can talk to them and make sure these numbers are right. And obviously, people have been suspicious about Chinese government reporting of their numbers, Chinese corporate reporting of their numbers for many, many years. And generally, the Chinese government has not allowed access to the auditors over there to see, by the U.S., to see if the books are right, because the Chinese government considers these, by and large, state secrets. So they're trying to work out a deal. Frankly, it's been too long. The SEC last year under Clayton indicated they were pretty fed up with the whole thing. There's a bill been passed in Congress that would basically start having severe penalties against companies that don't allow the access. Remember, it's the Chinese government, not the companies. So that's number one. Number two, the Chinese government itself is instituting a regulatory crackdown. They're trying to get more control over the free market over there. As much as you can say a free market in China, but they want more control over, particularly over the banking system. They want more control over what the tech companies are doing. To a certain extent, the U.S. government, by the way, wants to understand more about what these companies are doing too. So it's not completely crazy that the Chinese government want a little more control or understanding of what's going on. However, it seems to be going beyond that. There seems to be a re-rating of capitalism in China. Remember, capitalism in China opened up under Deng Xiaoping in the 1970s. It was glorious to get rich. And they've been going on that path, authoritarian government and a quasi-capitalist system. And now they seem, this is a little more than just, we'd like to get a little more control and understand what our companies are doing. This is sort of, much more authoritarian, Communist Party rhetoric stuff that's going on, a little beyond this. And everybody's trying to figure out what it all means. What it means for China investors is you might have to re-rate what they're worth. You might have to re-rate your balance. So remember, in the last 20 years, it's become easy to invest overseas because we have indexes that enable you to figure out, allocations, and we have ETFs where you can just buy right into these things. So people who have a global allocation say, okay, I'm buying into an index, the global index, and it's 5% weighted to China because China, it has a certain amount of stocks and the market capitalization is this amount. If I'm buying into an emerging market fund like EEM, for example, that's 40% weighted to China because China is considered emerging markets and that's the weighting China should have. So you sort of automatically, if you're investing overseas, have this weighting in China. Now some people are starting to say, well, wait a minute, just like I said, this stuff in China, this regulatory stuff is going beyond just that. The more government control. Does this mean we need to treat China as a separate asset class? Like it's the US, the rest of the world and China as a separate asset class? And should China stocks be rated lower? I mean, in terms of like what kind of multiple we put on it than we did before? This is a debate that's going on. I don't know the answer, by the way. I mean, I've given my opinion on what I think the China government is doing, but I don't know where it's going. I do know that there's a lot more debate about regulatory risk in China and how much that should influence stock prices. So this is an ongoing discussion right now.
Yeah, we'll definitely continue to keep our eyes on that. So the next question we have is, what do investors need to know about the VIX?
The VIX is the volatility index. This was invented, more than 30 years ago. And simply put, it measures an expectation of volatility on the S&P 500. Okay, so what does it mean? If the VIX, where's the VIX now? It's 21 or 22. The actual literal reading of the VIX, if it says 21, is investors in the S&P 500 are expecting the S&P to move plus or minus 21% in the next 30 days on an annualized basis. I know that sounds a little technical, but that's actually what it means. And when they say expecting it to move, they mean one standard deviation. I don't want to get into a statistics class, but a standard deviation basically is what is the range of expectations 68% of the time. It's a statistical calculation. So if the VIX is 21, investors in the S&P, and actually it's in options, are expecting the S&P to move 21%. On the probability of it could move as much as 21% on either side in the next 30 days on an annualized basis, with one standard deviation. That's 68% of the time. Does that sound pretty wide to you? Yeah, I mean, that's a lot in the next 30 days, that there's a 68%, one standard deviation probability that the S&P could move 21%. That's pretty wide. There are periods where this thing goes way higher than that. It can go to 40, 50. The periods in the last couple of years where it's gone that high. But you're basically trying to figure out, you're guessing on probabilities. And the problem here is the one thing that we don't figure out is future volatility. We don't have any idea what actually is going to happen. All this is a complete guess. And you notice how it goes up and down on an intraday basis, because human beings, are like, they freak out and they just say, oh my God, I think something's going to happen. COVID's going to shut down the economy again, for example. I'm going to buy puts. And they're tied, the VIX is tied to how much in the value of those puts and calls. And so they'll go up. And then literally the next day, there'll be less worries and people will buy fewer puts and they'll go down again. So if you think this is like, human beings just freaking out and then just calming down, that is essentially what it is. That the VIX is called a fear indicator exactly because of that. So is it useful for anything? It's useful for people who want to bet money on short-term volatility, I guess. I don't pay much attention to the VIX when it's hovering, around the 20s and belows. I really don't. The VIX is a sentiment indicator to a large extent. Not quite, but it's a sentiment indicator. And like most sentiment indicators, in my profession, in my history as a journalist watching this, sentiment indicators are most useful at extremes and not very useful when they're right in the middle in their normal trading range. Sorry if you, I did a whole thing on the VIX a long time ago, in 2011. So if you want to, Google VIX, CBOE Volatility Index, Trader Talk, you can probably still find it. But 10 years ago, I wrote a whole lengthy explanation of how the VIX is actually calculated.
Thanks, Bob. That's definitely helpful. So our last question is, do you have any tips for investing during these times?
Well, I don't do investment advice. I am I've said this many times, I'm a Jack Bogle disciple. I met Jack Bogle in the 1990s. He was the founder of Vanguard. He had, of all the people I've ever met, I met many, he's probably the most profound influence on the way I look at the markets. Jack had a very simple attitude. He was never against active management. He was never against people picking stocks. But he thought it was fairly rare to ever find anyone who was successful over the long term doing it when you net out fees and expenses. And he's right. I mean, historically, he's correct. He helped found that S&P 500 fund, was the first real index fund out there, and still there. Vanguard's Index 500, still there. And his point was, most investors are better off buying and holding index funds. Broad diversification, number one. Low cost index funds, number two. And avoiding concentration. That's what index funds do. They give you broader diversification. He had a couple of pet peeves. One was trading. Most people who are interested in trading the markets trade too much. Most people make trading mistakes, and that's what kills them. They trade too much. Secondly, there is a mythology around market timing that you can do it successfully. Bogle insisted, and the academic literature is very clear, he's right, market timing for almost everybody does not work. And the reason it doesn't is you have to be right going in and you have to be right going out. You have to do right twice. And the probability is you can do this, and I don't want to hear I bought, Tesla one week and then, next week I sold it. I want Bogle's point was, I want to see you do this week in and week out for 20 years. And you'll see, you won't beat the markets. There's been very good academic literature that indicates that the biggest gains of the year happen, 10 times a year, and people who aren't in on those 10 days, they don't get anywhere near what the normal market would be doing. And the problem is no one knows what days those 10 are, so it's impossible. So I came to believe this in the 90s after meeting with Bogle and some other people. Jeremy Siegel had written a book of several years before that, which is still out. I strongly advise you to see Jeremy's book, Stocks for the Long Run. There are other books. Charlie Ellis wrote a very famous book called Winning the Loser's Game, where he explained what the problem was with active stock picking versus passive stock picking. Burt Malkiel's book, A Random Walk Down Wall Street, has been out since 1973. There's also a variation on why it's nearly impossible to beat the market. So again, Bogle had active managers at Vanguard. He had Wellington. Those guys were really good, and they still are really good. But for most people, he made a point of saying, stick to our index funds. And I came to believe that in the late 90s. I still do, and I see no particular reason. The literature has not changed on this. Now, what about here's the problem, Katie. It's boring. You want to buy like a half a dozen funds and hold them for the rest of your life. You're 30 years old. You're going to live till 90. That's pretty boring. And Bogle knew this. Bogle always said, everybody always said, this is received wisdom now. If you really got that itch to trade, take 10% of your money and go trade it. Knock yourself out. But Bogle said, keep track of it. Keep track of what your real money is. Okay? If you put if you have $100,000, you trade $10,000. Keep track of that $10,000 you're trading and the real costs of what you're doing. The trading costs, the taxes you're paying for your active trading, the real cost, and then compare it to the cost of just holding an index fund where there's almost no cost at all, and just buy and hold. And he said, I'll bet you find you're not going to work. But go ahead. Bogle's had the right attitude. Knock yourself out, but don't do it with much of your money. That would be my advice. And I've never seen any particular reason to change that, Katie.
Well, that's great advice, Bob. And thank you so much for answering all of the questions. We had great questions again this week.
As always, you guys are on top of stuff. These are the right questions to ask. The right questions right now are COVID variant and the impact on consumer behavior, the Fed timetable for tapering and raising rates, and how is this going to play out in China? Those are the three big issues for investors right now.
Yeah, so we'll definitely be keeping our eyes on all of that. Thank you so much to everyone for
tuning in. Thanks, guys.
Again. Have a nice weekend. Happy Friday, and we'll see you in 2 weeks.
Great.